The broadcast is now starting. All attendees are in listen-only mode.
Okay, I want to welcome everybody to our webinar today. Just as we are getting started, I did want to do a couple of things and just do an audio check, make sure that everyone that is here can hear and see our screen. So first of all, if you can hear my voice and then see the screen, which is a bunch of wood stumps in the background with our name, Cedar Brokerage, on there, please press that raise hand button. That just allows us to see and know that you can hear and see our screen. Looks like we are there. So I definitely appreciate everybody who has signed up and is attending this webinar today. This will be a 1-hour duty drawback webinar. Throughout this webinar, everybody will be on mute, but we will address questions at the end in a Q&A section. So although you are on mute, you will be able to send us questions via the questions chat or chat box. So feel free to send them over to us. We'll address them towards the end. We'll try to address them throughout if we can, if we see them in time. But if we do not address it during, we will definitely address that question at the end. We know that many of you have also filled out the one-page questionnaire, sent it over to us, and we definitely appreciate that. That helps us to get a better idea of the attendees and your industry, their circumstances, and helps us to really make our presentation today based on your needs. However, we know that a 1-hour presentation, especially on something this complex, isn't quite everything that you will need in order to get a program going, or will answer every one of your questions. So we definitely encourage you to schedule a time for a call with us. Once you've sent the questionnaire in, let us review that and then schedule a time for us to review that and then give you a call back, see if we can help you answer questions, find your true potential of your drawback program, as well as help you guide you along the path of which program would work best for you to not only maximize your refund amount, but really to minimize your total overall duty liability as well. This webinar is a 1-hour webinar, but it is worth 1 CCS credit as well. So if you're interested in getting that CCS credit, make sure to send over your NEI information to us after this webinar. Just let me know what your NEI number is, as well as your contact information, and then we will get that submitted to the NCBFAA to get those attached to your credits as well. Again, we appreciate your time and your attendance, and we hope that this is a very worthwhile webinar. I'm going to turn the time over to Troy Larkin for this time. He will be presenting the webinar. And again, if you have any questions, please make sure to send them over in the chat box, and we will try to address them throughout, or at least through, if not throughout, towards the end of that presentation as well. So thank you. Troy, the time is now yours.
Chandler, thank you for the introduction, and we do welcome you here today. We've got companies all across the United States and also from Canada, so we do welcome our Canadian friends up north, as well as those who are attending. Today's going to be pretty quick one. As Chandler mentioned, we've got 1, 2, and 4-hour webinars we do, or seminars, that help companies understand about the drawback process, more detail and whatnot. So here, I'm going to talk pretty quick. I lived in Australia for 2 years. It's kind of ironic because when I came back home to the U.S., companies or individuals would say, "Man, you talk so fast." So I've got to apologize, especially if English is your second language, but there's a tremendous amount of data to cover here. But again, we can address your specific questions either in the Q&A box when we've got at the end, or you're welcome to contact us afterwards and we can go through that process. Just a little bit about Cedar Brokerage, who we are. We've been in business for the last 36 years. Our function is to, as a broker, as a custom house broker, we've got the rights and the privileges that all the brokers have, but our forte and our business model is very, very narrowly focused. We have the expertise of dealing with duty drawback, also with classifications of goods, because we found through doing the drawback process that many of our clients' classifications were in error or differed depending on which brokers they brought it in through. And also since the imposition of the 301 duties on goods coming in from China, and the exclusions and or piggybacking. Now, just last week, we had a webinar regarding how to piggyback onto the exclusions that are granted to companies if your company didn't have them. So we'll have education on a regular, consistent basis, and you're welcome to join us on any of those. But here today, again, is a condensed 1-hour version of Drawback. What we're going to do, though, is by the time you're done, you'll know what Drawback is. You're going to determine who actually qualifies for Drawback, the different types of drawback programs that are there, the required documentation, and how to determine how much drawback you actually have as a company yourself. So again, we appreciate your help and assistance. We're asked frequently, though, what type of industries which we deal with. And literally, about every given industry in the United States is one we've dealt with. Transportation, tremendous amount, from airlines to cruise lines, a lot with the auto industry, clothing, a significant amount, and also large equipment, small equipment, security, technology, bulk products coming into the United States being processed and also back out of the U.S. So virtually, like I say, anything that comes in the United States either goes out in that same condition or is further manufactured and is exported, or the caveat of destroyed, either one of those would qualify for duty drawback. So unique services which we provide. Left-hand side indicates that duty drawback, we implement what's called a privilege application to customs. We get our first step is to get the approval from customs. So we'll put together, gather specific information, submit it to customs, and while we're waiting for their approval, we then gather import and export documentation, file drawback claims. Those are held in suspension or what's called abeyance, and they're wait until the approval is given. As soon as the approval is given, we convert them to a full claim, and those refunds are realized as well. What can we get back? If you look at it, not only the customs duties, the tariffs, inclusive of the 301 tariffs, it still is just a standard duty and it is refundable. Customs fees, HMF and MPF, harbor maintenance fees, merchandise processing fees are refundable. Again, all at 99% unless you're with the petroleum industry and you get 100% back. We also have IR taxes or internal revenue taxes or the FET, the federal excise taxes that are refundable. Best way to say what those are, as you go and put a gallon of fuel in your car, you'll see a green sticker. First one's going to say 26.9 or 24.9 cents / some other amount. The very first part of that is the federal excise taxes on fuel, whether it's imported or produced domestically. If these goods are exported, the FET can get refunded as well. So also we're dealing with exclusions, as I mentioned, and then under related services, the classifications. Now we've got also partnered groups in which we deal with or affiliate companies on other products, but for our group, that really in a nutshell is the expertise in which we have. So what we're going to talk about today and focus on is primarily that duty drawback. Some unique things we do is, in particular, as we implement a drawback program, very, very different than any other drawback broker out there, is we facilitate third-party cooperation for drawback programs. So if you're not the importer of record, but you're the exporter of record, we can get a cooperation with the importer of record. In fact, the largest drawback program we implement, with a company that did $34 billion last year in sales, 100% of their goods that are exported were previously imported by another group. So their entire drawback program is putting this third-party preparation together where we provide the non-disclosure agreement to the importer of record, we gather the documentation and whatnot. But the same thing is true as if you're the importer of record but not the exporter of record. You sell your goods domestically and someone else exports the goods, you can literally cast a wider net and include them in your drawback program. And we're very, very good at that third-party participation of either importer or exporter as well. The second piece of the drawback that's probably the most complicated portion as far as companies gathering is going to be that international proof of export. And where needed, we can step in again and get the cooperation because we know so many of the shipping companies outside, or excuse me, within the United States that ship outside the United States, we can get their cooperation. But our whole function is to make drawback simple for your company. It's a complex process, but you literally would outsource to our group to implement the drawback program and ensure you keep in compliance. So the things we're doing is reduce your FTEs, your full-time employees' time and effort into it. It maximizes that return while we maintain compliance with customs rules and regulations. So the biggest question most people have, and it's been far more adamant since the 301 tariffs are impacted, is what's the impact to your business? I remember when they came out in June of 2018, in fact, just prior to that, companies were beside themselves saying, I cannot pass through these costs to my client. They won't pay the goods, especially if it's international. They won't pay these duty impacts. Or some will say, I can't afford to pay the tariffs. Others were concerned to indicate that, I've got to mitigate them one way or another. And this drawback program, there's no question, drawback is a wonderful opportunity to mitigate some of those 301s based on those items that are exported outside the United States. So if we jump into the 301s, what it is and how they implemented, it was actually came in phases, or what they call parts, that were also then broken down into lists. The very first implementation of the new List 1 was in July of 2018. That first group of goods coming in between List 1 and 2, because it was August that the List 2 kicked in, total was $50 billion of goods that were going to be tariffed at 25%. Now the question is rising, what's that $50 billion? Where does it come from? $50 billion was of those HTSUS were on List 1 and List 2. Annually, how much of those goods we bought from China historically? And that equated to roughly $50 billion of product that historically have been bought from China. So at 25%, you can see what the additional tariff would be. But in addition to that, USTR allowed for some of those companies, if you can show an undue burden, that these regulations of new duty was going to be very, very difficult for the United States. It was going to be difficult for an industry and even difficult for a company, or maybe it was only single source, that they could actually apply for a waiver or an exclusion as well. List 3 kicked in August of the same given year. Excuse me. Originally, it was implemented a 15% tariff on those goods, and it was another $200 billion of goods. So now we have $250 billion. And pretty quick after that, an additional 10% duty was applied. So now List 1, 2, and 3 were all at 25% duty on $250 billion of goods. Well, we went that way for a period of time, and then through negotiations with China, as they were progressing and perhaps not working as well, implemented List 4. List 4 got split into 4A and 4B. 4B was not imposed, 4A was. The initial duty on those 4A products was another 15% duty that through the negotiation with China, the U.S. reduced those in half, so now it's at 7.5% since that kicked in. The idea is that potentially the List 4B could be implemented down the road. And who knows, given the COVID and everything else with China and the problems, what will be implemented or not. Bottom line is, here are your 4 lists that are currently applicable, List 1 through 4. First 3 lists are 25%. List 4 now is reduced down to 7.5%. And if I'm imposed this additional duty on my goods coming from China, and I subsequently export them or destroy them, drawback is an opportunity for me and my company. The way that was imposed is if my original duty was 3% duty, and the additional duty I was on List 1, 2, or 3 was 25, now my duty is going to be 28% of those goods. And again, customers were actually just beside themselves saying, I cannot have 28% duty on my cost of goods sold, my import value, and be profitable. I've got to do something. So again, as we talk about, drawback is one item or one opportunity there, we can get it back. A couple of case studies, just to kind of give you a clue in. Case study one of our clients was actually a manufacturer of large valves. They're out in the Midwest. They came to us just prior to the implementation of the 301 duties. They said, we are spending roughly about $500,000 a year in duties, and we export 40% of those goods. Now that meant there's $20,000 refundable. It was a legitimate ability to get it back. But the real question was, does it make sense? Because it takes a lot of time, effort, and money to implement a drawback program. Granted, we work on a contingency basis, but at the same time, this would be $20,000 and then split. And for us, that would be too little dollars to chase based on the time, the effort, and the money. We indicated to them if something else changed, whether imposition of these new 301 duties, whether it was they had more exports, if they changed the duty rate, whatever the case may be, take a look at it, reevaluate it. Within just a couple of months, the imposition of list 1 and 2 hit, and now they're paying well over another million and a half dollars in duties. That, in addition to the original dollar amount they're paying, now put them in a position of say, okay, let's do a drawback program. Just by as a side note, they did have a number of items that we, in structuring the information here, put together for exclusion request, and a number of those exclusions were granted. So for a period of time, they gained the exclusion on some of those goods that came into the U.S. But note this, especially if you gain some exclusions during that time period, as of August, all products coming from China, with the exception of about 240 items that gained exclusions, are going to be now or have been taxed again at the list rate, 1, 2, or 3 at 25%, and of list 4 at 7.5%. So the full duties are now imposed again, that even though temporarily you got some exclusion, there are full duties that if you haven't done a drawback program, or even if you have but it's not expanded, you need to expand your drawback program to include these items as well. Case study 2 was one of our clients we had for a number of years, I think well over 10 years, been implemented a drawback program, and as we implemented that drawback program, it was based on their exports and also on the destroyed goods. But when list 1 and 2 kicked in, they had now an additional 1.2 million, or excuse me, not 1.2, $12 million of additional duties, and they were absolutely beside themselves. We had numerous conference calls with their upper management, their CFO, and their president of the company saying, what can we do to mitigate these things? Which we did. We continued to expand on the drawback program. But again, in this client's case, they also went through and were adamant about trying to file from exclusions, but they did gain some of those exclusions. But again, starting the 1st of August of 2020, those exclusions have gone away. Now we're implementing through the drawback program those additional benefits that come to them as well. So jumping into duty drawback, what is duty drawback? Duty drawback is a refund of imported duty-paid goods that are subsequently exported outside the United States or destroyed. It could be in the same condition it came into the U.S. We haven't changed it, haven't further manufactured it and then exported, or it could be something that came to the United States and further manufactured it and then exported as well. Now, there are some reductions or some exclusions we've got to talk about there as well. And we'll talk about it a little bit later on when we hit the NAFTA portion, the old NAFTA rules, the new USMCA agreement for manufacturing in the U.S. But outside of that, the mentality, imported duty-paid goods, subsequently exported, either in the same condition or manufactured, are going to qualify for drawback. I want to put this in perspective for you because really, when it comes to dollars and cents, it's what really helps most companies to say what really makes sense here as well. Historically, now this is prior to the 301s because Customs has not yet provided a report to say what's the impact of the 301s. So prior to June of 2018, every year prior and for a number of years, Customs had goods that were imported, duty paid, and subsequently exported that qualified for $2 billion a year of refundable duties that were going unclaimed. What was being claimed was only $1 billion of duty. I'm talking duty, not taxable value, but duty. $1 billion a year was being claimed. And so 2/3 of the available drawback were going unclaimed. And again, companies looked at this and said, well, difficult, hard to deal with, and we don't really want to get into it because we don't know. But I want to put in that perspective. So what we did is we gathered information from the top 50 Fortune 500 companies. And even though you may not be at top 50 Fortune 500 companies, you can at least plug yourself in to say, proportionally speaking to my return, what is my after-tax return? That's what you can do. Left-hand side of the screen shows that we used a 7.11% return, and this would be after taxes. How do we arrive at that? Gathered all of the income of the top 50 Fortune 500 companies, backed off all of their cost of goods sold. From there, we backed off all the administrative cost, which includes depreciation and their income taxes. The net income was an average of 7.11%. So this whole chart is based on that 7.11%, but yours would be based proportion what your return is after taxes. Left-hand side of the screen, from $0 to $30 million in additional sales. Bottom right would be the amount of refund of duties, anywhere from 50 grand up to $2 million a year. So if I'm getting back refunds of $250,000 from Customs because I paid those duties, how much would I have to sell on an annual basis to generate the same 250,000? I would have to be $3.5 million in additional sales in that given year to put $250,000 to the bottom line. For clients that have $1 million in refundable duties or more, I would have to generate another $14 million in sales to drop that same $1 million to the bottom line. Well, if you're going along as a business and doing what you're doing, if we can add 250 to $1 million or what that number is, regardless in between, that's as if you had those additional proportion of sales. It's no wonder CFOs and CEOs will take a look at duty drawback program and say, wait a minute, if we can qualify for drawback, why not? So really we have to determine, can we qualify? And if we do, what we've got to do, what types of drawback programs are available to us. So this type of chart really helps more companies better understand what their circumstances are and what's available to them. Basically, you can use a number of roughly 14%, or excuse me, 14 times every dollar that hits the bottom line is what you'd have to do in additional sales to generate that same money to the bottom line. It's interesting because some of the clients we've had have not had a tremendous amount of revenues, and yet we've increased drastically their percentage of overall profit by bringing back drawback, especially in these tough and difficult times as well. Many times, I just want to help you understand, drawbacks overlooked because either the lack of knowledge, war stories they've heard of some of the location they've been, problems they've had with customs in the past. But bottom line, if I'm bringing goods in and I'm subsequently exporting them, I'm going to qualify for drawback. And you just have to get a firm that knows and understands drawback, and that's what they do. In fact, our group has done exactly that. We've never, in the 36 years we've been around, we have never acted as a true import broker and have completed the paperwork. We've always had that forte and focus on duty drawback, and that's really the focus you need. So there's three entities that qualify for drawback, and I won't walk through who they are. Prior to the new TEFTA rules and regulations, there was a hierarchy. So what I'm going to do is I'm going to walk in the same hierarchy of who's available. If I am the exporter of record and also the importer of record, I'm going to stand in first position to claim drawback. What type of records do I need? On the left-hand side of the screen, it shows. On the import side, I need my commercial import invoice, and I should have that and better have it, but I need that, my packing list, and my entry summary. Now, granted, the packing list is not required by customs. It's not a statutory requirement. We require it as a company because over the 36 years we've realized that many times the invoice is insufficient in all the detail level necessary, but the packing list almost always will have that. So part of our process and documentation gathering, we'll get that packing slip. On the export side, again, three documents: commercial export invoice, packing list, and also the proof of exportation. Now know this, if I'm a manufacturer, I'm going to have manufacturing documentation in there that says what products are produced, what quantity of any day, and I can go back at any point in time and show you either the produced quantity of that given day of that product or the different types of products that were produced in that given day as well. But if I'm both the importer and exporter record, I should have all my documentation necessary for customs. If I file a privilege application with customs, say this is who we are, this is what we're doing, here's a sample documentation, and here are my import and export docs, I can then file drawback claims as well. Now, I make that sound pretty easy because it's far more complicated than that, but bottom line, this would be the ongoing consistent type of record keeping that would be necessary. Let's say I'm the exporter record, but I'm not the importer of record. The exporter record has to have the import documents on that import side, invoice, packing slip, and entry summary. They go to their supplier and say to them, hey, we want to put a drawback program together. We need your import documents, send them to us. Now you have to ask yourself, if you're the importer of record, would you be willing to provide your import documents to your company, your customer, who is exporting the goods so they can participate in the drawback program? And the answer, 99% of the time, is no. Why? Well, I've got sensitive information on my import documents. I've got the source of where it came from, the actual company that I'm dealing with. I'm also showing my cost of my goods. So you stop and think about it. As importer of record, if I provided my import documents to the exporter of record, I would absolutely lose every ounce of negotiation I had with them, because why? They would know what my costs are, and I'd be very hard pressed to either increase my pricing or even support where I'm at because they would know. So that is one of the main reasons my personal belief is that $2 billion a year we're going unclaimed is that lack of cooperation between an importer and an exporter of record. We noticed this early on, 30 years ago. We said, we've got to gain that cooperation. How can we do that? We put together a very, very in-depth 5-page NDA that we provide to the supplier. Our client, the exporter record, would introduce us to the supplier, indicating to you they want to participate in the drawback program. We would sign that NDA to say, supplier, any goods you're importing, any documentation you provide to us will not be divulged to our client and your customer, but we will marry your import documents with our client's export documents, and we will file the duty drawback. Again, I want to refer back. One of the largest clients we have and drawback programs is exactly this scenario. And if you think that is easy to get many, many, many suppliers to a $34 billion company on their exports, I'll tell you, it's another thing. But we are successful with what we're doing. We get their cooperation. We provide them the NDA. They provide us with the documentation, and we have ongoing claims for those clients on a regular and consistent basis. So who else qualifies for drawback? And that would be I apologize. Let me run through real quickly just on those documents. Claiming as the exporter record, if you're not the importer record, as the exporter record, again, commercial invoice, package slip, proof of export, and they're also going to provide the power of attorney to us as their drawback broker. We need to gather all those documentation. We provide an NDA to the importer of record and get their 3 import documents, invoice, packing slip, and entry summary, and from them get also what used to be called a certificate of delivery, but it's a third-party group saying that the drawback rights are now conveyed to the exporter of record. We now have everything we need if we file that privileged application with customs to then go on and file the drawback claims. Second individual that's available for drawback would be the importer of record. Now, granted, you got to take in consideration, this is conditional. This is conditional. The exporter of record is not filing drawback claims. Every time we ever talk to an importer of record, they said, well, we don't know if drawbacks are being filed or not. And I said, well, it's pretty simple. They said, how do you know? And the question would be, is your your customer, the one that's exporter of record, are they coming back to you for import documents? And if the answer is no, they cannot file drawback on the goods you're selling to them. Why? They have to have the import documents in order to correlate not only a line item of the products, but what the products are, the HTS, the amount of duty paid, HMF, MPF, everything associated with it. So if your customer is not coming back to you and you know they're exporting, you as an importer record could qualify for drawback, but it takes gaining cooperation with your customer to obtain the export documents. How do we do that? We do an exact reverse of what we just talked about in the last scenario. We're now representing the importer record. We go to their customer, the exporter record, and say with an NDA, you provide us the documentation, we will not provide this information back to your supplier, the importer of record, but we will marry those documents and claim drawback associated with that as well. That being the case, the importer of record can qualify for drawback. Is there anyone else who qualify? And the answer is yes. Third-party consignee. Company A is the importer record and pays the duties. Sells it domestically to Company B, the intermediate consignee. Company B sells it domestically to Company C within the United States, and C exports those goods. Now, I got to be honest, this is one of the most complicated types of drawback programs that are out there. Even though we've dealt with a lot of manufacturing that are pretty difficult, this is the toughest. Why? I've got to have 3 companies and 3 entities that are in compliance with the drawback rules and regulation. And if any one of these say no, this whole program's dead in the water. I've also got to get cooperation through an NDA from the exporter record to get not only his export docs, invoice, packing slip, proof of export. I've also got to get that letter endorsement from them, endorsing the drawback rights back to the immediate consignee. Same thing is true with the importer record. We've got to go to them and get the import invoice, packing slip, entry summary, and also that third-party waiver to give me as the intermediate consignee the ability to claim drawback. And again, as long as I've filed a privilege application with customs, I've jumped through the appropriate hoops, I've got the approval, I can submit my drawback claims and I can receive refunds. Now, this poses a question, and many of you will have this. If the importer of record shows as your import broker, or if your exports shows as a consolidator, or your shipping company is different than you, Can either one of those two entities claim drawback for themselves? And the answer is no. Why? Ownership and title are the drivers for drawback. Possession has nothing to do with duty drawback. So the broker on the import side, nor the freight forwarder on the export side could claim drawback on your products just because they were listed as either the importer record or the exporter record. Now, a nuance. We've negotiated with customs on something that is not right, but because the paperwork will say your broker is the importer record, and the paperwork may say that the shipping company is the exporter record or the consolidator, we get them to sign on the export side that letter of endorsement, endorsing the drawback rights back to you as a qualifying party, or the same thing on the importer record. If your broker's placed themselves as the importer record, they've got to endorse the drawback rights to you as well. And again, they don't technically have the ability to endorse those drawback rights, but that's what we've negotiated with customs to say we will get these documents. So on a paper flow, we can show the goods came in and also were trailed going out, and that your company would be listed as a qualifying company for duty drawback. So there's only three entities that qualify for drawback. First and foremost, the exporter record. Secondly, the importer record. And thirdly, the intermediate consignee. But in those last two cases, it definitely takes cooperation. And on the first case with the exporter record, if you're not the importer record, it takes cooperation with the others. Otherwise, duty drawback is dead in the water. And again, annually, $2 billion a year go unclaimed because of that. Two caveats that have come up because the new TEFTIA drawback rules. First and foremost is a certificate of delivery is no longer required on the importer record when they sell the goods to an exporter record or to that intermediate consignee. It used to be you actually had to have a CD, and it was filled out, had the documentation of the date, and have the data of the products that are in there, the date sold, the quantity, everything else, the values that are there, no longer required. Now it's ironic, and here's some of the fun things that customs does. They eliminated the requirement of the CD, but they still have the requirement of you need specific detail. So in essence, they should have left the CD in place because you still need that supporting documentation that that importer record has to file and claim and a statement saying, one, I haven't claimed drawback on these items in the past, and two, I will not in the future, plus the rights of drawback go on. And so we put together a third party assignment letter that assigns those drawback rights to whoever they sell the goods to. Secondly is that the new rules and regulations came out and said both the importer and the exporter record are both jointly and severably liable for a drawback claim that needs to be refunded to customs. So if a drawback claim it cannot be supported, customs will hold today both the importer and the exporter jointly and severably liable on that. So if I'm an importer record and I sell my goods and I've provided the third party, I'll tell you what, I would want to make sure that I got my backside covered. The exporter record goes and files a drawback claim and they've filed it wrong. Customs wants back $30,000. Now they could hold both the importer and the exporter liable jointly for those goods. Two ways to mitigate that. One is you can get agreement with your company you sell the goods to say that you'll put a full-blown drawback program together with accelerated privileges, and with every given claim, make sure you've got an accelerated drawback bond. Why? If that $30,000 customs goes back to the exporter record that filed the claim was in error, if it's not paid by the company, which they'll have the right and the ability to pay first off, if it's not solved, customs then could go back to the importer record. But what they do is they would go against that drawback bond or that insurance to ensure that customs is made whole. If that insurance bond or if that drawback bond is in place, customs go back, get the money for the bond, and the importer record be off the hook. Second piece I would say is an importer record. If I'm selling goods to the exporter record that's filing for drawback, I would indicate to them when I want an agreement with them that if customs comes after me for any amount of the drawback that they had filed for that was in error, that they will immediately make me whole, even if I have to pay that as well. So there are two ways to mitigate that, but just know that rule and regulation is now in effect that did not used to be there prior to the new TEFTIA rules and regulations. Let's talk about the different types of drawback program. Unused merchandise would be goods that come to the United States and in the same condition are subsequently exported. But no, I can do certain things to these unused goods, like test or clean, I can repair, I can cut, slit, I can actually replace some components, I can disassemble, I can unpack, and I can repack as well. So as long as anything I'm doing doesn't constitute manufacturing, I'm okay, and these goods come in as unused and go out as unused. Because my specific drawback program has to be detailed to the types of products I'm bringing in. And if I have a manufacturing process, I cannot file manufacturing under an unused claim. Same thing is true. If I've got unused claim, I can't file unused drawback under a manufacturing claim. I would have to have both types of drawback available and the privileges approved by customs prior to actually filing those different specific types. What if I have rejected merchandise, goods coming in the United States and are subsequently exported because they don't conform to specs or it's defective? We had a case where a full container of platform shoes came in. Now, for you guys a little bit older, you think platform shoes, you're thinking with 4 or 6 inch heel for a guy. Things are different today, quite different. These platform shoes would be a large base, and it's usually used for athletes. They use them anywhere from junior high all the way up through college and professional. They have these shoes and they're actually on a tilt, and they're virtually like a Converse shoe or whatnot. You slide your feet in there and you're on a tilt, but you also have a platform below. And what it does is it helps you on your vertical jump. And so it helps you improve that vertical jump. When they brought in this container and they started selling them, they realized as soon as people started using them, the base would separate from the shoe itself. And that was not good. You could have rolled ankles, you could have broken bones, all sorts of problems as well. They realized these goods were not good. They were defective at the time of importation. We gathered them all up, shipped them back out. But this way, on rejected merchandise, which I have an opportunity, if I don't have a full-blown drawback program, I have to notify customs prior to the export of the goods, and that would be using that 7553 procedure. I have to notify customs I got defective merchandise. I have to give from the factory that these products were bad at the time of importation. Then I have to give customs an opportunity to either inspect or waive their inspection. Then I can export the goods and I can claim duty drawback on rejected merchandise. We also have items that are destroyed. Many of our clients will be in technology-oriented businesses that no longer fit or conform. Batteries for certain phones or phone cases or cords. If I had an iPhone 8 and the new generation is iPhone 10 or 11X, I think they've got now, or just the X, they no longer are supplying anything from 8s. And so I have all my products that are 8 and cords, battery backups, cases, and all these things that I can't find anywhere else in the world to sell them. So then I turn around and I destroy them. And so through that destruction, we can again notify customs if I don't have a drawback program in place, give customs an opportunity to inspect. If customs doesn't want to inspect, we get a third party watch the destruction, they attest to the destruction, and then we can file a drawback claim. For most of our clients that are either manufactured or even unused, we will put in their privileges application a component for destruction that says I can now destroy any of my products as they're imported and exported without customs requirements. Why? Because I've got previous authority to do so, and I don't have to notify them prior to the destruction. But I throw a caution to you. If you do not have a full-blown drawback program in place, you never want to destroy your goods without notifying customs. Otherwise, those destructions will not qualify. You also always want to have a third-party witness attesting those goods were destroyed and what those products are to ensure that an independent third party is saying, yeah, these items were destroyed. I witnessed them, and they attest that to that fact as well. When we put a full-blown drawback program together, we put together and request certain privileges. We always request for a one-time waiver. If I have not given customs an opportunity in the last 5 years to inspect the goods prior to export, I need to request from customs a one-time waiver that they'll allow me to do so. And inevitably, they will always grant that one-time waiver. But I also want to stress, this is a one-time shot. We have companies that have started and stopped on drawback in different circumstances that try to go back for a second time for a one-time waiver, and customs rarely, if ever, will allow a second one-time waiver. You also want to put in place a waiver of prior notice, or WPN, meaning that on a go-forward basis from the date of signature, customs is also waiving their rights on a go-forward basis. So now I can import and export on a regular and consistent basis without having to notify customs that I'm exporting these goods, and I can still claim the drawback. For more speedy refunds of that, we always put together an accelerated drawback program and put our clients under that accelerated basis of saying, as soon as customs gives us a privileged approval and we submit a drawback claim, they'll agree to refund those claims within usually about a 2-month time period. Sometimes they stretch it to 3, but usually about 2, if we have accelerated drawback privileges and we've got an accelerated drawback claim. Just know, we've got clients that have been engaged in the drawback program for years, and in some cases, we'll get those refunds within just a couple of weeks. But typically, about a 2-month time period for the normal client that they'll get that back as well. If I'm going to use the principal substitution, I have to make sure that I in compliance with customs TEFTA requirements, which is at the 8 and 10 digit level, that I don't have anything categorized as other or other in both the 8 and the 10 digit level. And also, if I'm going to use a different accounting methodology, I've got to file for a privilege application with customs to say, I want to account differently. Maybe I want to track my drawback goods on a LIFO or a FIFO basis versus an average price new or a low to high, or whatever the case may be. You notify customs with what your privilege requests are, and this would be 5 that are typical, but we also engage in more. And with that, customs will respond and say, we're going to allow you to and grant you privileges of drawback based on the privileges you requested, and also based and subject to audit. You got to remember, you're going to apply for drawback privileges, but everything that approved is still in compliance. You're saying you're going to be in compliance with the rules and regulations as it applies to your specific group and company. Now, as we take a look also at the tracking methodologies, there's 2 methodologies in tracking. One is a direct ID and the other substitution. Direct identification would say that I've got a specific serial number or a non-repeating unique number that I can use. I can track it. I can also do the same thing by a lot. I can track everything that came in by a lot in my production facility and went out by a lot. I can track it that way. But what if you're not tracking anything with a serial number? Your goods are imported, don't have a unique identifier or a lot number. I've only got a part number. Can I use a direct ID? And the answer is absolutely yes, you can. Then you default to what type of accounting methodology? A LIFO, last in, first out. FIFO, first in, first out, average price new. There's others as well, including a low to high methodology. This method of tracking can be used anywhere in the world. That's not the same for substitution. You have some limitations. So it's a good methodology to utilize, but then you've got to make sure you're in compliance with the rules and regulations of the type of tracking you're going to do. Substitution is also a good methodology because it allows, on the new TEFTA rules and regulations, says if I bring parts in that at both the 8 and the 10, or excuse me, either the 8 or the 10 digit level have a specific title and description in the HTS US codes, I can bring it in under that 8 or 10 digit level, and I can export it on the 8 or 10 digit level. And I can say, even though it's a men's shirt that's a large cotton t-shirt, it also may be grouped with a group of men's or women's jackets. It's usually not crossover on sexes, so usually it's in the men's, but it may be a men's jacket is there. So if I export either the t-shirt or the jacket, as long as I'm matching up the 8 and 10 digit HTS and description, I can qualify for drawback on that. Now, also the limitations on using the principal substitution is that the pre-TEFTA rules and regulations, which is now the USMCA agreement, though we don't have the new rules and regulation out on the USMCA agreement, Customs is still working on that. We anticipate it should mimic what's on the TEFTA, or excuse me, on the NAFTA, is that the principal substitution cannot be used for direct ID goods. So, excuse me, let me restate that again. I'm thinking 2 things that I'm talking. Principal substitution cannot be used on unused merchandise going to either Canada or Mexico. It can only be the direct ID. If I'm manufacturing, I can use either direct ID or substitution of goods going to Canada, Mexico, but there are some limitations. We'll talk about the limitations when we get to the NAFTA, the USMCA agreement as well. So substitution is good, but you've got to look at all your products. If I have 60% of my products that have a specific category, but 40% don't, and they're other in 8 and 10 digits, you got to really stop, think long and hard. Do I want to have 2 different types of drawback program, one using direct ID and one using substitution? It may be easier to do your entire drawback program on direct ID rather than having the 2, because as soon as I start claiming on imports, I've got to stick with either direct ID or substitution, and I cannot cross those over on the same line item I'm going to go against if those goods were exported as well. So there are some real limitations. On the qualifying documentation that's needed, we've already talked about the import docs, invoice, packing slip, entry summary. On the export docs, invoice, packing slip, and proof of export. But when we put a privilege application, there's a lot more documentation we do. We actually track one item coming into not only into the EWS, but also into the inventory. Records showing it's hit the inventory, withdrawn from the inventory, and if it's manufacturing, my bill of materials, how the bill of materials matches. How do I pull it from my inventory to do the bill of materials for that product that is produced and maybe set back on the shelf, gone back in inventory, and then subsequently on the shelf, withdrawn from inventory and gone export as well. So we provide all that types of documentation, walking all the way from A to Z to customs on the privileges application. And with that documentation, we indicate to customs, this is what we're looking at. Customs previously would be 3 to 5 months when we put a privilege application together. They would give us approval with that. Three things that hit, and it's kind of the trifecta of storms. One, the TEFTA rules and regulations came out, which changed the old drawback to the new drawback. Two, with the ACE program, drawback was the very last thing to be implemented on the ACE program, and there were still a lot of problems, caveats with the ACE program as it related to drawback that have had to been worked on and changed during that time period. And then three, with the COVID, there's only 4 drawback offices that are available currently and have been for a period of time, but most all the drawback offices are still working from home. More difficult to get, more difficult to get a response, and let alone the privileges. So it's actually pushed it out to about 7 to 9 months to get the approval, even though every once in a while we get one quicker. Average approval from putting the privilege application in to customs approval is usually within 7 month time frame as well. Doesn't stop us. We can still submit drawback claims, but the idea is they're longer to give that approval. One of the other categories would be manufacturing. If I'm bringing goods in, let's say I'm bringing in a clear resin beads and a blue dye, and I put it through a blow mold machine and extrudes out the other side a water bottle, Dasani or any other name brands of the water bottle that's got that blue hue to it. As long as it has a very distinct name, character, or use, it is a water bottle. It's got a screw on top. That's what it's going to be used for. Obviously, we know it's manufacturing. And that's pretty simple to see. But there's a lot of other processes out there, including some items that are not manufacturing or not deemed typically manufacturing. I may be doing some assembly. So if I have a clutch plate and a clutch disc, and I'm going to bolt them together. I have 6 bolts. I'm going to do nothing more than bolt them together. I put it in a box, and that box is now for a Mazda 3 years 2017 through 2020. Simply because it's manufactured for a very specific use, even though it doesn't fit the criteria above in manufacturing, it's still going to be deemed manufacturing. So if your processes are assembly, you really ought to scrutinize all the assembly processes to say, is it going to fit manufacturing or is it going to fit unused? Because it could be either or. But no, many times that manufacturing will also extend out to the assembly process as well. And it's pertinent to get drawback claims and programs approved based on the actual manufacturing or unused. So if we take a look at the manufacturing for just a minute, and just know we've got a 4-hour webinar that goes in far more detail of the manufacturing, and you're welcome to join us anytime on that. But you use what's called a BOM, or a bill of materials. The bill of materials, and I want you to look just at the top half of the screen. Let's say, for example, we're manufacturing a pump in the middle of the screen that says this pump is an HL34WD. Left-hand side shows there's a valve, a case, and a gauge. $9, $17, and $12 on my cost of my parts. Prior to the new TEFTA rules and regulation came in, I was at 3% duty. So here, when I finish that product and it goes back into my inventory, and if exported, I have $1.14 that I could recoup back 99% of these items that go export. Not a huge incentive for drawback because the value is so low. But now we take a look at the new information with the new TEFTA rules and regulations and the 301 tariffs. So the same valve, case, and gauge at $9, $17, and $12, but the new 25 and the 3% duty. I'm still producing the exact same pump in the middle, that HL34WD, but now for every pump I produce, I'm $10.64 in duties that I get 99% of that back. If I've got 10,000 or 100,000 or a million of these pumps that are being exported, now that's really what builds and drives a manufacturing drawback process, especially with these new 301 duties. And we do this every given day for our manufacturers and our unused, because exponentially their drawback return is significantly greater as well. Well, let's talk about the statute of limitation time periods. It used to be pre-TEFTA rules, the old drawback rules, that if I'm unused, my statute of limitations would differ if I'm manufacturing. If I'm manufacturing, if it was a direct ID and I was going, or versus a substitution, my drawback rules and my extension of the statute of limitation time period would be different as well. One thing I did like out of the new TFTA rules and regulations, they standardize it. They said from the date of import to the date of the date of filing the claim, which would imply exports has been in there as well. You have a 5-year window, statute of limitations, to file it. So every time we take on a new client, we look back up to 5 full years saying what imports have come in during that time period, and when exports have gone out, they're going to qualify for drawback. So that 5-year window is a great window to have, but now it's consistent. Unused, manufacturing, direct ID, substitution, doesn't matter what countries you're shipping them to, all of the same statute of limitations exist. Now let's talk about the statute of limitations for retaining records. That is different. We've been part of the duty drawback subcommittee that have been specifically working with customs over the last almost just 5 years now. 3 years prior to the implementation of the new TFTA rules and regulation, they came to industry and said, we want your feedback, we want your input, and we made suggestions. They originally were going to change this to a 5-year anniversary from the liquidation date, and it's liquidation of drawback, not liquidation of imports. You had to retain your records. They agreed by the time everything was said and done to a 3-year window of the date of liquidation. But let's stop and think for a minute. You implement a drawback program and you look back 5 years. You need to maintain those records from 5-year time period to date of filing the claim. It takes customs roughly about 1 year to liquidate that drawback claim. So now I have to have records for 6-year time period. And the statute of limitations says I have to maintain them for 3 additional years. You literally have a 9-year window of required retention of those records if you went back statutorily up to 5 full years. That's 2 years longer than IRS requires corporations to have records, which is a 7-year window. So again, a strong recommendation we have of you implementing your own drawback program is you maintain your records separate from the standard corporate records. Why? Because requirements could be you have to maintain those records for 2 additional years, and 2, you would have all of the supporting documentation at your fingertips if and when customs comes and audits you. And I can tell you this, many times we've had clients say, oh yeah, it's in our regular records. They go out to the records to pull that, especially physical records. For some reason, files didn't get put back in the same place, same order, and it's not intentional, but all of a sudden they don't have the records needed. So that eliminates that requirement, or excuse me, it eliminates the process and possibility of not having the record retention we need as well. Well, let's talk about the NAFTA agreement. I'm a little bit long, I'm a little long-winded, I'm running short, but the NAFTA agreement says, the USMCA agreement now, if you're importing goods into the United States and subsequently exporting them in the same condition, it's now going to be or unused, you can get full drawback back. But for manufacturing in the United States and then sent to a NAFTA country, you can only get the lesser of the two. That means the lesser amount of the duties paid as goods are imported in the United States as compared to the duties going into Canada or Mexico. In that same example before, $10.31 on that pump. But if I sell that pump to Canada, one to Canada, one to Mexico, Canada is duty free because that's the whole purpose of the NAFTA agreement was to reduce it down to very, very small duties or duty free. And Mexico is going to be 1%. If that pump was a $50 pump, duty free into Canada, and yet $10 coming to the US, I have no available for drawback because the lesser of two would be 0. The lesser of the two going to Mexico at 1% of the $50 is now 50 cents as compared to $10.31. For manufacturing in the United States going to a NAFTA country or the new USMCA agreement, drawback usually is unavailable, unattainable. Right here, I want you to know and understand, probably the most difficult process of the entire drawback process is to have the appropriate proof of exportation. Usually customs sees goods of international bill of lading, international airway bill, or international freightway bill. They will also accept import documents into Canada or Mexico, the B3 going into Canada, the Pedimento going into Mexico. If they're importing in the other countries, they're also proof that it's exported outside the United States. They will also accept express carrier, but just having a tracking number is insufficient. And most companies that are using express carriers are not getting the proof of delivery, or the POD. Express carriers like UPS, FedEx, and DHL have come out and said, we're no longer going to retain these records for any extended period of time. And if you want these going backwards, we'll get it for you for $50 each, which is ludicrous because that could kill your drawback program as well. So if you're shipping using an express carrier, international shipments, we would strongly recommend it. Start today, go backwards as far as you can and get those PODs, because that's the only thing that's going to save your backside in the event you have the proof of exports for the drawback program as well. Silver lining for duty drawback on imported duty paid goods is that we can get 99% back of the duties, the HMF and the MPF, and also the IR taxes that are applicable to what you're doing. Now, no, I just mentioned to you early on that we had an exclusion webinar last week. You can piggyback, and you really ought to look at this if you have not. You can piggyback exclusions were granted to other companies as long as you have the same product and you're going to fit not only the HTS but also that description with it as well. Well, there's some recommendations which we are making here, and I don't want to overstay our time period, so I'm just going to really stress that very first one. Never make a drawback claim that you do not have the documentation. You make sure you've got documentation, and in order to support your claim, because customs is not always right. In fact, we proved them wrong on a number of occasions. You make sure you've got all the documentation necessary. Well, I'm going to tab down here a little bit because we are out of time. I want you to really just look at that questionnaire we put together, that one-page questionnaire, because what we're doing is that really is the driver. You complete that one-page questionnaire on a no-cost basis. We'll evaluate that questionnaire. We'll get back with you, make some recommendations of what's available to your firm through drawback and what's available to you as refundable as a whole. I'm going to turn the time back over to Chandler. We really appreciate your cooperation here, and we'll get into the Q&A section next.
Yeah, again, we appreciate all of your time and attendance in this webinar today. Again, just as a quick reminder, if you are interested in those CCE credits for this webinar, it is 1 credit. Just be sure to send over your NEI number to us as well as your contact information. And we'll be sure to get that put into your credits with the NCBFAA. We appreciate your time today. We do have some questions coming in. And again, since we had everybody on mute, the only way to do this realistically is through this question and chat box. So if you could send over any questions that you do have at this time, we'll review those, we'll go over them, we'll answer them. And then again, if you want to get into greater detail with these on a one-on-one basis, we highly recommend filling out that questionnaire, getting it back to us, and then requesting a time for a phone call where we can do a more specific one-on-one with your company. In specific, this will help you to really derive what the opportunity is for a drawback program, the types of programs that you could have, as well as the overall opportunity in refund amounts for not only duties themselves, but those 301 tariffs that we had mentioned. So again, feel free to send over those questions at this time, and then also email me with some times for a phone call if you'd like to go into this in greater detail. We'd be more than happy to do so. We also have a copy of this webinar that we can send out probably starting tomorrow if you're interested in viewing it and reviewing the information that was gone over during this presentation, because we do understand it is a lot of information. Duty drawback is hard to summarize into a 1-hour presentation and realistically get an overview and a good idea of everything that's going on. So again, we will send out a copy of this presentation to you so that you can have that to view as basically your time is needed and as you are able to. And then reach out to us. Feel free to contact us, call us, email us, whatever you can. We will be more than happy to help you put together a program, help you obtain these refunds, because realistically, these are duties that are eligible for refunds. And if you're not obtaining refunds on those, not even working with another company, if you're not the exporter of record, for example, then these duties are just sitting there and the government is utilizing them and not refunding them back to you. And 100% of the time, it should be given back to you at the 99% refund rate. So we would love to talk to you more about this, more about the 301 lawsuit that's coming up, ways to do duty deferral through HTS US classification, anything along those lines. Feel free to reach out to us and we'll be happy to do so. It looks like we do have some questions coming in this time. So I'll just jump into this with Troy. So let's go over those. And again, feel free to send those in as well.
All right, first question we've got is our company issues an international BOL at the time of pickup. Is this sufficient for a proof of export? That's a good question because typically companies will actually issue, Chandler calls them frequently backdoor BLs, but BLs that are going out, but from your company. It would not be sufficient for the proof of export. The reason on that as well, a company cannot export their own goods and then go back to customs and say, hey, I've got a proof of export. I was the exporter record. That's one of the reasons these international BLs or freightway bills are so imperative. But if you have a trucking company that's going to pick up these goods and ship them to Canada, is a good example. They take them usually all the way into Canada, and typically they will have an international freightway bill that you can actually look at as well. If not, they'll have a pro number, and you can use this in conjunction to the pro number to get the proof that it was actually picked up your facility and dropped off to the end user. It also is a good note as well because that express carrier I talked about just a minute ago, FedEx, UPS, DHL, or the like, you can get your tracking number. You make sure you get a POD at the same time as well. Alrighty, let's see. Another question we've got here is how do I determine who or if I am a good candidate for drawback? That's actually a good question. Bottom line is anything that comes into the U.S. that a duty is paid, whether you import it directly or even if your supplier imports it, if you're exporting those goods outside the United States, you're going to qualify for drawback. Now it's really driven by what's my volume, how much duty is at stake, and what do I have to do to put it together. But so again, if I'm importing, paying the duties, and exporting, those are going to be ones that are good candidates as well. Many time we'll take a look at information, and from our standpoint, we'll indicate that as long as we've got about $100,000 a year in refundable duties, they would be programs in which we will take a look at and implement as well. I've got another question here that says, many of our shipments are sent to a consolidator for export. Can I obtain a proof of export and will this qualify? We do, many of our clients, in fact, we have a lot out of South Florida, and even they will ship through South Florida and other locations that are consolidated goods. You got one container going to a certain country, and they may have 10 different companies' goods in that container. You do have to, and it's required by statute, we have to have that international proof of export. And we got to determine who is listed. If your company is listed as the exporter record, no problems. If the shipper is listed as the exporter record, which many times the transportation company will be listed, we then need to get that letter of endorsement endorsing drawback rights back to you as a company that got consolidated in a container. We also sometimes will take a look at the manifest listing, and because the manifest a lot of times will identify who the company is to have the goods inside the container that's subsequently exported as well. So there's different ways and means to go through and show that proof of export. But will they cooperate? For the most part, those shipping companies will cooperate in getting you and providing you with a copy of the international BL. And also, if the BL is inaccurate, needs some adjustment, they'll work with you on providing the LOE or providing other manifest documents as well. All right, looks like we got one more question here. If I'm not happy with my drawback provider, they're about 2.5 years behind in our filings. How long does it take for your company to take over and implement a process to run a program? Again, a good question. For many of our large clients in particular, they've had drawback brokers working with them and have been in arrears for a long time. And ironically, that money is yours and you need to have it sooner than later. And usually for all of our clients, we bring them current and we file for them on a monthly basis as well. Usually what we can do is once they're introduced to your old drawback broker, we get with them and we request some documentation. If any given import entry had 1,000 units on it, but they've used 495 of those units, we need to get a starting point to say what has not been drawn against. With that starting point, we then put a methodology in place to gather the import docs, gather the export docs on a regular, consistent basis, and then we begin filing for you and bring you up to current much more rapidly than otherwise. So yes, we can take it over. Yes, we have taken it over, and many times companies will come to us because they're not happy with the current drawback provider. But yes, we are very good at that, and that is what we do. Chandler, I don't see any other questions there unless something else comes through.
No, it looks like that's all that we have for today. Again, we appreciate your attendance. We will get you out a recording of this webinar for you to view at your leisure, as well as we hope that this was worthwhile for you. Again, please feel free to contact us, reach out to us. We'd love to help you obtain these refunds for your company, obtain the opportunity for drawback, and realistically help you simplify the process while maximizing your overall refunds for a duty drawback program. Again, feel free to reach out to myself, Chandler, or Troy at any time, and we'll be happy to help you with any of these topics. Again, we appreciate your time today, and we hope that you found this webinar to be worthwhile. Thank you.
Thanks.